The top business stories live from the Sky News City studio. Apple to allow rival app stores on its devices following pressure from Brussels. A formal investigation is launched into the proposed merger between Vodafone UK and 3 UK. Plus, the race for AI domination. Elon Musk looking to raise up to $6 billion for a startup to compete with ChatGPT. Good afternoon, this is Business Live with me, Ian King. Apple has caved into pressure from Brussels and agreed to make significant changes to its iPhone and App Store in response to a change in EU law. The changes include allowing iPhone users in the EU to use app stores other than the one operated by Apple for the first time. Apple has also agreed to give iPhone and iPad users a range of browsers to choose from as their default and will also allow the use of alternative payment systems to Apple Pay. Users will also be able to uninstall Apple's pre-installed apps and replace them with third-party ones. Well, joining me now is Damien Girardin, outside counsel to the Coalition for App Fairness and partner at Girardin Partners. Damien, welcome to you. I mean, on the face of it, this feels like a big change, but you're quite sceptical.
I am, and I think I've spoken to a number of app developers today, and they're disappointed by what Apple is offering. The Digital Markets Act has two objectives. One is to introduce more competition in digital markets. The second one is to introduce more fairness. And I think that the compliance proposal that is made by Apple falls short on both marks. I think that if you look at it briefly, you think that they comply. But if you look at it a little bit more deeply, if you read the fine print, there are many problems, which I'm willing to explain.
Well, please do so. I mean, it looks as though certainly Apple is going to be putting up obstacles to app developers.
Yes. So, I mean, if you look at the way they implement a number of provisions whereby they should be allowing third-party app stores side loading, which is, downloading apps from outside the App Store, but also the use of alternative payment solutions. That is, in theory, possible, but in practice, it will be very hard. And the reason is that Apple is introducing friction. That means that you need their approval. There will be multiple steps and processes. And on top of that, they will include, for example, in some instances, warning, scary language, which will disincentivize users and, by the same token, app developers to use these solutions. So there's a clear problem there. And this is something we have already denounced in the past when Apple was forced to make concessions, for example, in South Korea or in the Netherlands following regulatory intervention. But they haven't learned anything from this. Or actually, they may have learned from this that the way not to change anything is indeed to make things possible, but extremely difficult. If you look at commissions, because that's another area of dispute between app developers and Apple. As you know, the standard commission is 30%. It's a lot of money. If you make 100,000, you have to pay 30,000. And the reduced commission for smaller app business program or, in other instances, is 15%. Now we're moving to 17% and 10%. So you may think, great, big reductions. But again, the devil is in the details. First, you have now to pay what they called a CTF, which is basically a core technology fee, which means that for over a certain number of downloads, you have to pay 50 cents per download. Actually, if you use an alternative app store, it is 50 cents from the first download. So it means that although there is a concession on the fee, if you add up the different elements, such as, for example, okay, it's down to 17%, but you have to pay extra for payment processing. You have to pay this core technology thing. If you start, looking at the various additions you need to pay, to get your app in the App Store, it's still very costly. So,
Damien, do you think Apple is setting itself up for a confrontation here with the EU then?
Yes, I mean, I've been dealing for the past 20 years with a lot of big tech companies, but Apple is extremely vindictive. Apple is unwilling to make concessions. We've seen that in multiple settings, before regulators, before legislators, in court, and so on. So I think they're basically making a stand. We detest the DMA, and they say it very clearly in their plan. I mean, in their announcement, they say it's terrible. It's going to make things worse. We don't want it at all. So they don't like it. They make it very clear, but they also make clear that they're not pushovers, that they will maintain their stand. And in my view, it's literally certain that their plan will either be rejected by the Commission, or the Commission will force them to change it, to improve it, which I don't think is likely, or it will end up in court. It will end up in court. App developers who will use court proceedings to get their way.
Damien, very briefly, if you would, please, any idea on how much this might cost Apple if these proposals go through as Apple wants them to?
It might cost them a little bit of money, but I think it's going to be marginal, because what they give on the one hand, they recoup it on the other hand. So again, it looks like they're making concessions. They do make some concessions, but overall, the picture is not bad at all for them. If they can get away with that, they will have won.
OK, Damien, appreciate you joining me today. It's a complicated topic. Thanks for talking us through it.
Thanks for having me.
Some other business news stories for you now. And the Competition and Markets Authority said today it had launched a formal investigation into the proposed merger between Vodafone's UK business and 3UK. The deal, first announced in June last year, would bring together the third and fourth biggest operators in the UK market, and they would leapfrog EE, owned by BT, to become the market leader by customer numbers. Well, the CMA now has 40 working days to assess whether the deal may lead to a substantial lessening of competition, and if so, whether a more in-depth Phase 2 investigation is required. Tesla's chief executive Elon Musk is reportedly seeking to raise up to $6 billion for his planned new artificial intelligence startup to compete with OpenAI, the company behind ChatGPT. The Financial Times says Mr. Musk's startup, XAI, has courted wealthy individuals and investors around the world in recent weeks, including family offices in Hong Kong, sovereign wealth funds in the Middle East, and investors in Japan and South Korea. The FT says he is targeting a valuation of $20 billion for XAI. Now, as the UK heads towards a general election, the two main parties are delivering mixed messages on decarbonisation. The government has pushed back the date for phasing out new petrol and diesel vehicles, while one of its own MPs, Chris Skidmore, has just resigned over ministerial support for new oil and gas licences. Meanwhile, Labour's commitment to spending £28 billion annually on low-carbon infrastructure also appears to be wavering. Well, joining me now is Jonathan Maxwell, Chief Executive and founding partner of Sustainable Development Capital, which funds and operates energy efficiency and energy generation projects. Jonathan, welcome to you. Do you think commitment to the green agenda is faltering?
I think we've had quite a long period of time when the commitment to the energy agenda in the UK has been faltering. I think Labour obviously has been struggling with its £28 billion promise. We've seen slight rollbacks in policy from the British government. This is to say, having said that, UK really has done well compared to a lot of other countries on decarbonisation. But the current policy framework doesn't compare in any way to what's going on in Europe or North America. And it puts the UK at, I think, quite serious risk.
Really? You think we're behind the US and with all their gas guzzlers?
Well, the US is an incredible energy position. Since 2019, it's been energy independent. It's the biggest producer of oil and gas in the world's biggest petrostate. But it's also got the historic $370 billion programme to stimulate the clean energy market. So in terms of energy security, decarbonisation, and frankly, just keeping costs under control, they're doing reasonably well. Europe, by the way, had a terrible time after the Russian invasion of Ukraine, but they're doing something about it. There's a massive programme for energy efficiency in Europe. Industry, buildings, transport have mandated, 28 member countries across Europe have got mandated productivity, energy intensity edicts coming out of the European Union. if you look at what that's going to do, it will at least help Europe become more competitive, doing the same or more with less energy, which is very expensive. Today, it's costing us in Europe twice the price for gas as it does in America because we import. I'm afraid the UK doesn't have policies like this.
Yeah. I mean, the Chancellor, were he here, would no doubt say, well, look, I've just put £2 billion into helping the transition to electric vehicles, another billion into supporting the aerospace sector develop low-carbon alternatives.
He might do, and by the way, that's massively welcome, and I would thank him for that. Having said that, we have a massively inefficient energy economy. Number one, we have nothing as a competitive discussion to have with America or Europe because just the sheer scale of mobilisation. I'm not just talking about subsidies, I'm talking about policy that actually helps to improve competitive advantage. What I would say back to the Chancellor is we have a huge opportunity in the UK, actually, to lead by being much more efficient with the way that we use our energy. We're an importer, we're an island. And we're very smart, we've got great engineering, great education. So there is a great way for us to be competitive. But one of the best ways, energy efficiency, they dissolved the Energy Efficiency Task Force last year. So, I'm afraid I think there's a lot to do on energy policy in the UK.
Now, since we last spoke, you've raised a €650 million fund backed by the EU's investment arm as well. What sort of projects are you looking to back?
So we build energy where it's needed. What normally happens is energy gets plugged into the grid. Nobody talks about this, but most primary energy, that is the oil, gas, coal, but even renewables, gets lost on the way to the point of use through extraction, conversion, generation, transmission, distribution. So we try and solve that problem by building energy on site. In fact, our total portfolio is around $2.5 billion now. About half of it's in America, about 35% in Europe, 15% here. And that's the biggest solution to this problem, building energy where it's needed rather than in the middle of nowhere and losing the heat and quite a lot of the electricity on the way. The other thing we do is we help reduce the amount of energy that's needed in the first place. 70% of energy is used in buildings, industry and transport, and you can reduce that footprint by 30% relatively easily. That's why the European Commission has mandated the member states to get on and do it, not by 2030, by increments of every single year. They have to make productivity, energy intensity gains. And the last thing I'll say on that, if we've only talked about Europe and North America, the leaders on energy intensity and the leaders in renewable energy, in fact, the leaders on any new energy production, are China.
Which will amaze people, given the perception that they're still burning coal like it's going out of fashion.
Well, they are. They've got a big problem to solve. 55% of all energy in China is still coal, 9% natural gas. A small but growing part of it, a very fast-growing part of it, is renewables. But that's the scale of the job that the Chinese have got to do. But I'm afraid this is also the real world. We talk about renewable power and the incredible growth, and we are investors and love it. But it's very small. We always talk about electricity, but that's small. That's only 20% of energy. And renewables is only a third of that at the moment. So there is a real world that has to transition here under the energy transition. But in the meantime, countries like the UK, continents like Europe and North America, we have to figure out how not just to be low carbon, but low cost and available, reliable, have energy security. And I think that's where there's a lot more work to do in the UK. OK, Jonathan, got to leave it there. Good to see you again this afternoon. Thank you. Still to come here on Business Live, we'll have a look at how the markets have finished the week. Stay with us.
Sky News.
From the Sky News Centre at 7.
Now that you're up to date, we can go into a bit more detail.
Things can change incredibly quickly.
Taken by surprise.
Have you ever known a moment like this in British politics before? Yes. Cheers.
We'll start with breaking news.
Let's get the latest on the ground.
So, by the end, we'll hopefully all understand what's going on in the world just that little better.
I'm Inzamam Rashid and I'm Sky's North of England correspondent, telling stories from this culturally rich region I call home.
If the Taliban found your family, what would happen?
I think they're just going to straight away execute them.
There are issues of racism in all levels of cricket.
I was on the balcony a couple of times. I was nearly gone.
Football is a joy to watch. When people are disappointed, you can feel the hate.
I've always tried to put people at the heart of the story, like hearing from young women who've been spiked via injections.
I just felt physically sick. That's really in my system.
Men, they want to force you doing something which you don't want to do, just because you're homeless.
We give a voice to communities often unheard and unserved from a region with a distinct history and global impact.
I just took a shower above the clouds. You know why? Because this is the Emirates A380. Fly Emirates, fly better.
Well, the US dollar has fallen this afternoon after the US inflation figure for December came in at 2.6% year on year. That was unchanged from November and bang in line with Wall Street expectations. With the headline figure now below 3% for 3 consecutive months, it's seen as helping the case for US interest rate cuts. By the middle of the year, as you can see, sterling slightly up against the dollar, the euro up by nearly a fifth of 1% against the greenback, sterling actually down by nearly 1/10 of 1% against the single currency. On the equity markets, where European stocks have made a positive finish to their best week so far in 2024, the standout is the CAC 40 in France. Look at that in the top right-hand corner, up nearly 2.5%. And the main reason for that is that LVMH, which is the biggest company on the CAC 40, it's the second largest company in Europe, in fact, up nearly 13% in Paris after its quarterly results published overnight were well received. I think, back of a fag packet, that adds about 50 billion euros to LVMH's market cap. Well, here in London, the FTSE 100 has also had a good session, finished up nearly 1.5%. That's the FTSE's first weekly gain in 4. It's been a broad-based rally. The leading blue-chip gainer today has been Burberry, the luxury goods group. That's obviously on the back of the strong LVMH figures, while another leading blue-chip gainer today has been Diageo. That's up 5% following strong results from its French rival, Rémy Cointreau. Diageo's rise there has put nearly 15 points onto the FTSE by itself. Elsewhere, the specialty chemicals group Croda appears to have attracted some bargain hunters after hitting its lowest level for a year earlier in the week. Outside the FTSE 100, Wizz Air is the leading mid-cap gainer. That's following its trading update yesterday, finishing 5.25% to the good. Meanwhile, the energy services provider Hunting is up 6%. That is on supportive broker comment. Over on Wall Street, it's been quite quiet after the inline inflation figures. As you can see, the Nasdaq in slightly negative territory right now. It's been another really busy 24 hours for company results. Intel has fallen by 11% after its update, disappointed the market, down now nearly 10.5%. In fact, Visa, meanwhile, that's off 1.75% after its results following last night's closing bell. To the upside, well, American Express is currently more than 7.5% higher. It reported record full-year sales for 2023 and reported better than expected profits. As for the oil price, well, that yesterday hit its highest level since the 30th of November, following the bigger than expected drawdown in US crude stocks earlier in the week. It has not really managed to consolidate those gains this afternoon. A barrel of Brent crude currently changing hands at $81.72 a barrel. That's down nearly 0.9%. The oil price has, by the way, posted gains in 3 of the last 4 weeks. Well, joining me this afternoon is David Morrison, Senior Market Analyst at Trade Nation. David, good to see you this afternoon. Yeah. Everyone was watching out for the US inflation numbers. A bit of a dank squib in the end, wasn't it?
It was. I just do think there was some relief that it didn't do what CPI did and tick higher, because we have seen some of those inflation indicators just tick higher recently, not just in the States, but Europe and the UK as well. So coming in nicely below 3% and sort of still on that downward trajectory has been positive for the markets, and a bit of a relief, I think.
Yeah. Does it change the Fed's thinking in any way, shape or form?
I don't think so, because I think the other thing that the Fed are looking at is the strength of the underlying strength of the US economy. And unemployment is still near record low levels, and we've still got very, well, when you compare it to the rest of the world, apart from maybe China, you've got GDP coming in at very good levels. We're now that we've got the first look at the fourth quarter GDP, which came in higher than expected, plus 3.3% against plus 2%. That's putting like growth for the whole year at around 2.5%. And if you think that people were expecting a recession this time last year, that's not a bad performance.
It's a stunning performance, isn't it? Now, in terms of the individual companies reporting today, I mean, Intel, a bit disappointing. I mean, it's also knocked a few of the other chip stocks this afternoon.
It has. I think it was the forward guidance that didn't help there. And that, of course, we saw a fall in AMD and also Nvidia, and so that sort of dragged the sector down in a bit like the same way that LVMH has pushed up the sectors in luxury goods and drinks.
Yeah, stunning showing in LVMH. Now, next week, of course, we get some of the so-called Magnificent Seven. You've already mentioned Nvidia. What are you going to be looking out for?
Yeah, next week, we've already had Tesla. That was the first to report, and that was a pretty dire one. Again, it was a warning. It was a warning about looking forward for demand in 2024 and thinking it's going to be lower than expected. Now, that also hit a lot of the Chinese EV makers like XPeng, NIO and Li Autos. Now we go ahead. This coming week, we're going to see 5 of the Magnificent Seven report. And so it is the biggest week, because after this, then all we've got to do is wait for Nvidia. And if you think about how much those stocks contributed to the gains last year, and for the most part, they're still up this year. It's only Tesla, really, that is down 27% this year, which is the bad performer. And in fact, has dropped out of the Magnificent Seven now.
Does that mean if any of these companies fall short, we could get a bit of a sell-off on Wall Street next week?
It wouldn't be surprising, given how far we have come with really quite shallow pullbacks since the end of October. I think markets might be looking for an excuse to take some profits. They've been very resilient, even as the expectation for the first rate cut from the Fed has gone from March to maybe April, May, or even June. So it's skating on thin ice.
Yeah, it's been an extraordinary start to the year, hasn't it? I mean, briefly, David, a word on the oil price. Are you surprised to not see it consolidating gains this afternoon?
Well, it's interesting. The one thing I would say about oil is that this week it broke out of an area of resistance, and in fact a range that's been there certainly since the beginning of the year. So on a technical level, it's possible that we get a bit of a pullback and then oil starts to push higher once again, unless it falls back quite quickly next week back into the range. But, that's one to sort of keep a close eye on.
Yeah, a lot of concerns still out there about demand, aren't there?
Very much so.
Got to leave it there. Great to see you this afternoon. Thank you.
Thank you.
That's it from me. I'm back again on Monday with our next edition. That will be at 11:30. Hope very much you'll be able to join me for that. In the meantime, do stay tuned. Coming up after this short break, Jonathan Samuels will be back with the News Hour. Have a great weekend. Thanks for joining me today. Cheerio.